Well, good afternoon, everyone. My name is RJ Kelly, and I'm founder and chief visionary officer of Wealth Legacy Group here in San Diego. We've got clients in 19 states, but we get to call this wonderful city and sometimes questionable state, but anyway, get to call it home. So delighted to have you with us. We'll have other folks coming in. I'm truly honored by some of the folks that have signed up for our humble little webinar today. Truly several of the top estate planning attorneys in the country, and several that I work with, as well as some of our top real estate, either developers or commercial real estate agents and residential real estate agents, just to name a few of the professions that are here. But all of you, thank you so much for joining us here today, and I hope that this will bring you value. I certainly, as usual, the person who does the work and does the research learns the most from it. So that would be me. I frankly found some things that were more than a little disturbing, but also confident that God is still on the throne, and we've got some ideas that can hopefully be helpful to you today. As the saying goes, if you ever see a turtle on a fence post, you know that he didn't get there by himself. And that is very much true for me. So I want to do a special shout out to our Wealth Legacy Group team, my beautiful wife, Vimian, who's our chief operating officer, our in-house attorney, Brian, and great friend for many years now, Olha, who you've seen probably a lot of her work, our marketing manager, Valentina, newest to our team, but just doing incredibly wonderful things to help. Floor, our bookkeeper, and then some more that is being added to our bench strength, which I hope to announce very soon. And also, thank you very much for donating. Several of you really stepped up to the plate, pun intended. But I want to thank each of you for donating to the San Diego Food Bank. Already today, we have raised close to 2,500 meals so far. So thank you so much for that. That's just fantastic. The food bank does an amazing job, and I hope you've all have been there to see it. And if not, please go by and see. You will be so impressed by the way that they run their operation. Now, one of a very, very bright young tax attorney that I know and think quite highly of, and I won't mention any names, but he said, RJ, this is just too political. Now, the Biden sledgehammer, I'm assuming I know how he voted in the last election, but he said, I just can't come. It's too political, without knowing, of course, anything at all about what we're going to talk about. But in my tax training that I've had, getting my master's, all taxes are political. That's how the government chooses for us, if we let them, how they're going to support the social well-being of the country. I'm going to share with you some ideas today about how you can take back control and you can self-direct the money to go to the causes and the things that you believe in. But all taxes are political. And boy, oh boy, if you didn't believe it before, when you look at what this new infrastructure plan, among other things, is designed to do and where the money is going on anything but infrastructure, you got to believe it's extremely political. So my goals for today, just simply this. I'm not here to take sides. I certainly not that at all. My goal is to just simply inform you of what is being not just proposed, but this has been being talked about now for several years. You have to hand it to Joe Biden. I mean, he's been telling us, not just hiding it, other than packing the Supreme Court where he declined to take a position, but he's been telling us. I've been in my research. It's been fascinating to see all the things that he laid out prior that are now very much in the bills that are being proposed. So my goals for today, threefold, is identify areas of potential tax change and what that's going to mean to us. Also, what those implications are and what are some strategies, of course, to deal with changes that may come. And then last, just wrap up with some concluding ideas and thoughts, again, on where do we go from here. The highlights, if you want to call it that way, it's helpful, I think, for us to really get a feel for what is coming and what's been proposed. So here's a couple things. The American Rescue Act, that was the one that was the emergency relief bill. That was 1.9 trillion by itself. The American Jobs Act, that's the one that is being proposed that well, I'll give you the timeline here shortly, but that's another 2.3 trillion. And then on top of that, and I wasn't aware of this, for my in-house attorney, Brian, said, did you know about this? I said, I didn't. But the American Families Plan, that's what President Biden calls his human infrastructure plan, is another $1.7 trillion. And that includes expanded child tax credits. It includes a great deal more of healthcare benefits, paid family and medical leave, all of which we, the taxpayers, are going to pay for. Plus, if you step back and look, under President Trump, in his 4 years, our national debt increased by $7 trillion. Went from a little bit over 18 trillion to just about 25 trillion. It is, and most of that actually came in the last year as the virus relief packages were rolled out. Our US debt to GDP ratio is currently 130%, and that's before the almost $6 trillion of the 3 different Biden spending programs. 130% of our GDP. Now, what's that mean to us? I mean, how does that relate? Well, for the first time, March 1st, we crossed $28 trillion, first time ever in history. And as of yesterday, it was over $30 trillion. And here's the implications. Historically, when debt to GDP ratio is greater than 90%, and remember, it's 130%, and that's before the $6 trillion of the Biden proposals, economic growth has been shown to slow by roughly 30%. So it offsets the whole plan of the creation of jobs, improving the overall financial state of our country and families, when you've got this enormous friction that's coming because of this 130% of ratio, which actually will probably be closer to 140 by the time these 3 acts, the $6 trillion gets reflected. Now, I found this fascinating as well. Not only are we under siege from the economics of things in this virus, but were you aware that China has now digitized their yuan? They are taking on the US dollar head on and challenging us for being the reserve currency of the world. Now, the US has not digitized their currency yet for several reasons. We're kind of behind. And what's fascinating to me and scary, actually, is that the 2022 Olympics, China has already announced that they're going to be providing everything for the Olympics on an app, including the ability to use the yuan in a digitized form. But in reading some of the now behind the scenes stories that are starting to come out, and the fears of those that the Olympic Committee has not taken a stand yet, but the opportunities that the Chinese are going to take for literally stealing genetic information from the best athletes in the world. So it's more than just financial gain. We are under attack as a dominant country and culture, and China is not the only one, but they're the biggest one. Now, if you are on our monthly newsletter, and if you are not receiving our monthly newsletters, I will give you a number that you can text to. Just text the letters WLG to that 5-letter number, 22828, by the way. That's what you text to. And just put WLG, and we'll be happy to add you to our newsletter. But in this month's newsletter, we really get into kind of the weeds. Thank you, Brian, again, our in-house attorney, for really getting into the numbers. But roughly 650 billion, according to the Washington Post, is going for the things we might call traditional infrastructure. Now, actually about 250 billion of that 650 is very questionable, because it is about retrofitting housing that is for, maybe that counts as infrastructure, but it's low income housing. So some are saying that doesn't count, but another 400 billion is for elderly and disabled home care. How does that fit into infrastructure? Not quite sure. Low-income housing and upgrading public schools. Gosh, I thought we had already spent a lot of billions of dollars on doing that, but nope, more coming. 300 billion to revive US manufacturing, but the emphasis there is on green energy. And so a lot of the other industries that are fossil fuels and other things, are being told, don't bother, we're not going to be giving you any money. 400 billion for clean energy credits, again, putting recharging stations across the country. I'm all for broadband and increasing benefits that way, but putting recharging stations, and then behind that, of course, is this second bill that President Biden is calling his human infrastructure, $1.7 trillion. So how do we get to pay for all that? Well, taxes. And what are the timelines? Before, I thought it was, I thought that President Biden had all of a sudden missed some of the opportunities, because I thought he was going to try to get the tax changes in through this year in 2021. But now I realize how very clever they're being, because the goal is he wants the programs to be in place by Memorial Day. And that, trying to move something off of my screen here. So he wants to get the new legislation of this 2.3 trillion in place and signed as early as Memorial Day, and have it pass over the summer without, whether or not the Republicans get on board. They have proposed a $650 billion, yeah, billions and trillions, what? Yeah, dollar here, dollar there. So the Republicans have put together a very streamlined package directly related towards infrastructure, true traditional infrastructure. But President Biden has indicated that he is not interested in having bipartisan support. Now, there is one Democrat that we've got to be sure and make phone calls to and send emails to if you want to try and stop some of the things that this steamroller that's coming at us. And that's Joe Manchin, sorry about mispronouncing his name, the senator from West Virginia. He truly is, he's taken some positions against his party. I got to respect him. And he has said that he will block the infrastructure vote if the legislation does not include bipartisan support, and if the Republicans are not included in trying to work out a compromise deal. That's gutsy to go against his own party. So we'll see what happens there. That's in the Senate. But I think it would be entirely appropriate, if you appreciate that kind of courage, that you do send him an email or make a phone call. I certainly plan to. So how are they going to pay for all this? Well, the one that's been getting a lot of press is the plan to raise the corporate tax rates. Now, President Trump, in his tax bill, lowered corporate tax rates from 20 to 21%, from 35%, which was a marked improvement. Now, it wasn't an actual 21%, because you have to factor in the state taxes. And that is, in my research, I was surprised to see it as high as it is. Of course, California, we know that. But across the country, it actually comes corporate-wise to about 32% is what the effective tax rate is going to be. It's not, so if Biden raises it to 28%, it's really going to be 32%. And that would be the highest there are 37 countries that are major economies that are part of an organization of economic support. And that would put us at the very highest level in comparison with the other 36. Now, the White House, I have to laugh about this one. The White House says, oh, don't worry. Just the United States, even though we're going to be proposing putting them in a 28% corporate tax bracket, the worst in the world, we're going to work with those other countries to avoid our companies going and setting up operations in those lower tax jurisdictions. Right. Yeah, even Janet Yellen started drinking that Kool-Aid. I'm not buying it for a minute. On top of that, though, again, in my research, I was surprised to find that there are really 3 different levels of taxes that the Biden administration is proposing to increase. There's also a global minimum tax. So corporations, Coca-Cola and others that have international operations, they pay taxes on the profits in those various countries. And so what Biden is now proposing, President Biden, don't mean to sound disrespectful, is a 21%, which is unusually high. In fact, no one else is anywhere close to that number. And the third tax is corporations are allowed to take depreciation and other things to lower their taxable income. And so on their tax returns, they pay taxes according to the rules and regulations in the IRS code. But that's not good enough. So President Biden has proposed that there will be a minimum tax of 15% on financial profits before taking into account things like depreciation and other things that are perfectly acceptable as deductions. So the long and short of it is that 28% will actually be much higher than that. So what will happen is our corporations will be much less competitive, and it will actually bring about job losses, not job gains. But guess who pays for that ultimately? We do, the taxpayers. So it's going to be, in this case, not only the taxpayers, in this case, it's going to be, we're going to be paying for the Coke or whatever it is that someone's going to buy those higher prices, because corporations are going to pass those along. Now, here's some of the other things that, and don't fret, but I know we've got several major national developers on this call and on this webinar right now. And one of the things that was just being planned to be changed is not only a higher tax bracket, basically putting it back to where it was before. It was 39.6. That's not so onerous. That's going to hit $4,000 a year of income, a net income, but we don't know whether that's going to be on a family or whether that's an individual. So far, there's been no indication either way. But one of the other things that they're talking about that's not getting press is they're talking about capping the itemized deductions at 28%. And most of the high income families are itemizing. So to cap it at 28% would just, again, increase the amount of taxes. But for our developer friends and our real estate friends, we've got a number of top home real estate as well as commercial real estate agents on our call right now, and then others that will be listening later. The big one is the elimination of the 1031 exchange. And they've tried that in the past, they being other sides, particularly on a certain party that starts with D. They have proposed that several times, but this one I think is going to go through for a couple of reasons. One, it is a great tax raiser, but the other one is because it's another way to poke President Trump in his world of being a real estate developer. So it has a double benefit from their perspective. I really think it's very likely to pass this time, but don't worry, there are 8 to 10 different options we can use that are alternatives to a 1031 exchange. So don't fret, but we don't have time to talk about them today. I'll give you one example when we do a little bit later here in our webinar, but there are some other options out there. In fact, I see one of the other folks that logged in with us who used one of those alternative transactions. Hello, Tony. Good to have you with us. The other thing that's looking at being changed and getting a lot of press on it, I don't think it will go through though, is a change in what we call how basis is established. When someone dies, someone passes away, right now we have what's called a step up in basis. And again, for most of you on this call, I'm sure that's something that's not new to you. It just means that, in fact, in a community property state such as we have in California, we get a double benefit, because as long as an asset, say it's a home, if that home is titled as community property, not just joint tenancy with rights of survivorship, but as community property, not only does the deceased half get a step up in basis. So if you bought the house for $500,000, it's now worth $2.5 million. That spouse that passed away, their $250,000 gets a basis increased all the way up to $1.25 million. But if it's joint tenancy with rights of survivorship, and that's how the titling is on the asset, the surviving spouse does not get the step up in basis. But in community property law, we can actually have it as long as this title is community property inside the living trust or outside. Both halves will get a step up in basis. So on that $2.5 million example I just used, you could sell it the next day and pay 0 capital gains tax. Well, they're looking very seriously at eliminating the step up in basis at death and going to what's called carryover basis. So if you bought an asset, and it's been tried before, but if you buy an asset 25 years ago, 50 years ago, 100 years ago, you got to come up with the basis, and they're going to tax then the gain. If you can't come up with proof of basis, then you're going to pay tax on the entire gain. So if you bought something for $500,000 and you put another $500,000 of improvements in it, so you're $1 million is your basis. But if you can't prove it, they're going to basically treat it at 0, and you're going to pay tax, capital gains taxes on the entire gain. It's an absolute mess. That's why it's never been used in the past successfully. There's some other countries that try it, but they're much smaller than us. And even with the advent of microchip and being able to track these things, it's still a mess. On top of that, the estate tax rate, which we'll talk more about in a minute, is likely higher than the long-term capital gains tax rate anyway. So I just see that there are several compelling reasons why it probably won't pass, or at least not on this time. Now, here's another shocker, and that is how they're going to change the deduction for retirement accounts. So instead of having a tax deduction, they're going to make it a tax credit. But you got to just chuckle to yourself, because they're saying, oh, by changing it to a tax credit, that will allow those that don't have much in the way of income to put money into a retirement account where they can get a tax credit. Well, as we'll look at it in a minute, the upper 50% of the income earners pay 97% of all the income taxes. The issue is not, as several very well respected those in the community have said, the poor are not poor because the rich are rich. And I might paraphrase it to say that the poor or the lower incomes are not putting money into a retirement plan because others that are doing well economically are putting more away. No, it's just simply that they don't have enough additional income to be able to put money into a retirement account. That's where corporate employers are hopefully stepping up and putting some money away. That's where the emphasis needs to be, not on penalizing those that are trying to set money aside to be able to provide for retirement so they don't have to be reliant on relatives, friends, or charity. There's another move, and this one also gets a little bit concerning if you don't have a 1031 exchange and if you're not using some of the alternative strategies. The discussion is increasing the long-term capital gains tax rate from the present 20% maximum to almost, well, basically to the income tax rate, the maximum rate, 39.6. So if you thought it was bad selling property in California, where it's currently 20%, wow, it's going to get a whole lot worse. There's also the movement to reduce our federal estate tax exemption amount from the current $11,700,000 per person, which means that actually about only 2,000 families in the United States this last year had to file an estate tax return because the exemptions are so high. So it's either going to likely end up at 3.5 million or 5 million. Bernie Sanders has proposed 3.5 million. President Biden is pushing for 5 million. So that would be, if you're married, that would be 10 million. And the good news is, though, and we'll talk more about this in strategy time, the good news is this is not likely to take effect until next year, and they're also not likely to claw back or go back to 2021. So it does leave a wide open door on a couple of great strategies we'll get to in a minute. One of the reasons why I don't think it's going to go to 3.5 million, I think it'll be 5 million, is just simply IRS can't hire enough trained tax attorneys to do all of the audits if they were to lower it to 3.5 million per person or 7 million for a family. There just simply are not enough of them out there. Now they can try, but because all of those estate tax returns are audited, every one of them. So that's a lot of people they're going to have to find. So that's why I think it's going to end up at 5 million. Now, a couple of other things. They're going to take some hits on some traditional planning tools. One of them, and as well in terms of the rate, right now the federal estate tax rate, if you go above that 11,700,000 or 5 million per person, potentially, the rate on anything above that is 40% presently. And so what's being proposed is that it go to 45%. But I honestly think it wouldn't surprise me if they might even go up to 50. It's easy. Right now, they've got the votes, and it's that rich person that's not paying enough of their fair share. So why not hit them at 50%? Wouldn't surprise me. One of the other changes, though, and this is really, really, really significant, is a limit on the gift tax abilities to make gifts during our lifetime. So right now it is integrated, it's unlimited. So yes, if you pay, every person gets a $15,000 gift limit per person, per beneficiary per year. That's also being proposed to be changed to where a husband and wife would get a maximum of 15,000 per spouse, period. So 30,000. But in this case, we can make our 15,000 a year per beneficiary unlimited. We can then give away to our kids or other heirs or to others part of our 11,700,000 each. So for a family, you can actually potentially give away up to almost $30 million. I'll show you how in a minute. But what President Biden is proposing is that that would be capped at $1 million if it's an individual or $2 million for family. Now, I'm not a huge fan of grant or retain annuity trust. That's where, for example, on a house, it's kind of heads you in, tails you break even strategy. It's a way of getting an asset out of your estate. If you live long enough, the asset moves out of your estate. If you die before the end of the time period, it just stays in your estate and gets taxed anyway. So that's why I said the head you in, tails you break even. But that will be eliminated, as well as what we call valuation adjustments, or being able to take a dollar and say, because it's a minority interest in a company or it's a minority interest in a piece of real estate, we're going to give you a discount. So a dollar is not worth a dollar. Or conversely, if we have $23 million of assets and we've got other assets that may be part of a limited liability company or something, we can take and move out up to $30 million of assets and pay no gift tax and get it out of the estate. So there would be no future estate tax. That's going to be gone. That kind of valuation adjustments for minority interest discounts and lack of marketability. Quickly on a couple things, there are going to be some expansion of some things that are already in place. We're just going to raise the amount. So this earned income tax credit, basically, it was available if you had kids living at home. Now you got to kick the kids out. So go have them live with somebody else. You get a little bit extra. Whoever benefits from this for the low income will get a little bit extra money. This is significant. Probably not a bad idea, although I don't see it why it's in an infrastructure bill. Put it someplace else. But it would propose to change the child independent care credit from the current $4,000 per child to a maximum $8,000 per family, a tax credit, not a tax deduction. And this does have to be used when you're either with a job or looking for a job. So it's only for out-of-pocket expenses. So I like that. I just don't see it as an infrastructure. But again, that's part of the package. And also they're bringing back the first-time homebuyer tax credit of $15,000. And what's interesting is, so for your real estate agents that are listening right now and will be listening later, that's going to be paid immediately. So first-time home buyer, they don't have to wait to apply and get that benefit when they do their tax return. Nope. Not quite sure how they're going to work it out, but it's available immediately on the purchase of the home. So here's a question, though. Let's get down to it. Are the rich really paying their fair share? I mean, how many times did you hear in the campaign, and plenty of other times as well, but especially in the campaign, this last presidential campaign, the rich are not paying their fair share? Oh, really? How do the numbers really turn up for that? So this literally just came out, I believe yesterday or the day before. So it's the updated data for 2018, and it just came out for 2021. So this is fresh hot off the presses from the Tax Foundation. And what's significant about this, it measures the first year of President Trump's Tax Cuts and Jobs Act. So that's why I find this especially rich to look at for resource and understanding. What did that do? Because the criticism of the Tax Cuts and Jobs Act was, oh, that's just for the rich. It's going to lower their tax bills. It doesn't do anything for the common man or woman. Well, it turns out, couldn't be farther from the truth on that. Brand new high. The top 1% of all the income earners in America paid over 40% of all federal income tax in 2018. So instead of the Tax Cuts and Jobs Act reducing their share, it actually increased it, and has increased over the last 7 years. It's increased substantially, actually. Here's fascinating to me as well. The top 1% pays more income tax federally than the bottom 90% combined. Now, part of that is because we have a tax rate that changes as the more income, it's a graduated tax system. So the average tax rate for the upper 1% is 25.4%, but it's only 3.4% tax rate for the bottom 50%. Not just the bottom 10% or no, the bottom 50%, their average tax rate is 3.4%. So what's this about the upper 1%? And by the way, the upper 10% is if you make $150,000 in America, you're in the top 10% of income earners. Fascinating. So you start looking at this, it's like, who's really paying the fair share? So I mentioned this a moment ago, 50%, if you take the upper 50% of all income earners in America, they're paying 97% of all federal income taxes. Now, did you hear the story about the fellow that unfortunately fell from a 20-story building? And as he whistled by the 5th floor, someone heard him say, well, so far, so good. Now, why am I telling you that story? Because right now we have an opportunity to do some rather remarkable tax planning. And apparently we're going to be able to do it for the entire 2011, but you can't wait till the end. I mean, one of my dear friends who's on this call, again, one of the top estate planning attorneys and tax attorneys in the country, Howard Nieswander, he's just buried. I mean, I almost hate to bring additional clients in but he is so good that I got to do that. But it's just, poor guy is working all these weekends, and I know I'm going to get a hate letter from his wife one of these days, but he's assured me that's not going to happen. So I'm relieved. But the point of it is that you can't wait on some of these ideas until the end of the year. We need to really jump on them now. What's coming is not going to be pretty, but we can do some things. So as Mark Twain pointed out, what gets us into trouble is oftentimes not what we don't know, it's what we know for sure that just ain't so. What we know for sure, it just ain't so. Now, what am I talking about, and how does that relate to what I've just shared with you? So most wealthy, affluent Americans, they understand that we have an obligation to support the social well-being of our country. But what they don't know, because they either haven't been told or because their advisors either don't know it or they do know, but they don't tell them, is that the government gives us a choice in how we support the social well-being of the country. If we don't choose, they choose for us. And we call that, everybody, all at once, yep, taxes. They choose for us, that's what it's called. But what, as Mark Twain pointed out to us, what I want to share with you is make sure you understand that capital gains taxes are voluntary. They're optional. You don't have to pay them, and you won't go to jail. Now, I know that's an outrageous thought. It gets even more outrageous because estate taxes and inheritance taxes are also optional. The 3.8% Medicare surtax, optional. 30% to 50% of our state and federal income tax, optional. Do you see the trend here? The common theme is that it's optional if you do this instead. And what's that? If you choose in advance how you're going to support the social well-being of the country or the city or the state or the world, that's all permitted. It's part of a tax bill I'll introduce you to in a minute if you're not familiar with it. Most are not. And it's okay to opt out of the tax system and support the social well-being of the country in a way that's in alignment with your own values system. That's okay. So let me go back and give a really quick 30,000-foot view and just stay with me. There's a point in my sharing with this. In the mid-60s, there was a very, very significant movement towards philanthropy for individuals in the United States. That brought about what's called the Tax Reform Act of 1969. Again, that's before I started practice, but I have read that act significantly. And also we work in this area a great deal. And that Tax Act created a whole bunch of different tools. I won't bore you with the details, but they're all referenced as what's called a split interest technique or split interest tool, meaning that it's okay to do something good for you and your family, like opting out of capital gains taxes, estate tax, income tax, so forth, as long as you are helping someone else. And so there were various tools, techniques, strategies that were created. We'll look at one of them in just a minute. But if you're willing to support the social well-being in a way that works for you, nice things are going to happen. Like what? Well, how about forgiving all of the taxes on the sale of appreciated real estate? Because right now, if you sell a piece of appreciated asset, whether that's a business, stocks, real estate, anything above your gain, your basis actually, they will forgive. If we use some techniques, they'll forgive the taxes upon the sale. And in California right now, if you add the federal long-term capital gains tax rate, the state income tax rate, because California has no capital gains tax rate, it's all ordinary income, and you add in the 3% Medicare surtax, that's almost 40%. And if what Biden is proposing happens, if it's $1 million sale or greater, that's going to end up being almost a 57% tax bracket in California between federal capital gains tax, now it will be at 40, state, and the Medicare surtax. So if you thought it was bad now, wait till next year and beyond. So if we use instead this tool, or one of these tools, not only can we eliminate all of the taxes, but we also get an inflation, typically an inflation adjusted income stream that can in fact go up to 3 generations. So you, your kids, your grandkids, if you got them. As well, the assets are protected from creditors, which in California, it's almost impossible to be able to do that other than having a pension plan. Plus, on top of that, you get significant income tax deductions. I'm not making this stuff up, gang. This is in the code. So how does it apply to the Biden tax sledgehammer? Well, let's look at a couple of quick cases. I'll introduce you to something that I call the Capital Gains Alternative Trust. Don't look it up in the tax code. That's my name for it. We're also going to look, because I know there's situations that are coming up now. In fact, was just on a situation yesterday where we're looking at what would be about $1 million of taxable event, and they were just going to pay the taxes. Just the father is sort of running behind in terms of some of his mental capacities. And so it was just simpler for the family if they thought, well, we're just not finding anything we can exchange into. Let's just go ahead and sell it and bite the bullet and pay the tax. It's like, oh, you don't have to do that. So let me give you an example. This is a storage facility in Los Angeles. At the time it was built, it was worth about $500,000. At the time I got brought in by another financial advisor, the basis was basically almost zero. It was $35,000. The fair market value, however, of the storage facility was over $2 million. So they were just going to go ahead and bite the bullet. His wife didn't want to do a 1031 exchange. She was 65, he was 70. He wanted to try and find something, but she didn't. They weren't making, frankly, a lot of money on the deal. Their net after maintenance for the properties, property tax and everything else was only a little bit over $50,000 a year. Now, he thought that was a pretty good deal because they were, if looking at, well, I'm getting ahead, so I'm going to hold that thought, come back to this. So in terms of closing costs, we were looking at over 100,000 in closing costs, but the big number, and this is back then, was almost $750,000 in various taxes, which would be far worse if the sale was happening in 2022. And again, for them, 1031 was not an option for them. And as we've already talked about, it may not be an option for anyone next year, but again, don't worry. There are anywhere from 8 to 10 different alternative strategies we can use to either eliminate the tax or at least defer it for 30 years. So here's one of them. Again, this is my name for it. It was created in the 1969 Tax Act. And it allows for 0 state, federal, Medicare taxes on the sale. Now, it has to be done correctly, it has to be done especially several months in advance of a sale. So in California, I'm a very conservative tax practitioner, so I advise typically 3 months or longer, but we would create this tax exempt trust, put the asset into it, then we would start marketing the property or starting to take bids on the property, but in the name of the tax exempt trust. So if we look at income stream, in terms of what we would net from the property, that comes out at 6% of income stream. That'd be $126,000 a year of income for the rest of their lives, with the opportunity for increasing that income as well. Now remember, before they were only making $52,000 of income. And so we're looking at more than doubling their income stream. On top of that, though, they received over 1.1, nearly so, $1.1 million of income tax deduction that can be used. Oftentimes we create so much income tax deduction, it can't be used all at once. So fortunately, there are up to 6 years, tax years, that we can use that deduction. Also, because of the way it's structured, the way the special kind of trust is, those assets are protected against creditors. Now, the individual can't access the principal. That's the downside. But the flip side to that coin is that neither can creditors access the principal. And with one of the types of tools, we can actually buy more real estate inside that tax exempt trust and can use leverage. Normally with tax exempt trusts like this, say a charitable remainder trust, you can't use leverage, but with the tool I'm talking about, you can. Now, the ultimate beneficiary after, in this case, they chose to just simply have it be when both the husband and wife pass away, which might be 30, 35 years from now. Whatever's left in the bucket, when they kick the bucket, goes to their family giving fund. But as I said, it could go as long as 3 generations. Now, there could be also some inclusion for estate tax purposes, so I'm not going to get in the weeds on that. But did you know you could do this? Again, what gets us in trouble is not what we don't know as much as what we know for sure that just ain't so. And most people just can't believe that they don't have to pay capital gains tax or federal income tax on a portion of the sale or get massive income tax deductions, but you can. Okay, moving along. What about situations where you've already had a liquidity event? We were brought into a situation, and it has to be the same tax year, by the way. So lovely, lovely couple, some of our favorite couples. At the time he was 79, she was 82. They sold both a business and property for about $7.5 million. In the course of that, it generated over $2.1 million in various taxes between the federal, state, Medicare, and so forth. So unfortunately, they didn't find me until after the liquidity event occurred, or otherwise it could have been zero. They would have paid no tax on the sale. But even though it was after the fact, we were able to institute two different planning ideas that created over $3 million of tax deduction. And we're able to take their tax bill, not to zero, unfortunately, but from 2.1 million, we were able to apply enough tax deduction to bring their tax bill down to 937,000, which for this country boy from Yakima, Washington, that's still a ton of money, but they were thrilled to pieces because saving $1.2 million, and actually it turned out to be more than $1.2 million, was a very, very happy outcome. Okay, so what else do we have? Well, do you know there are banks out there that are willing to loan money at 2 to 3%, 3.5%? I'm not talking about buying real estate. I'm talking about putting it into an asset protected trust, either in Nevada, South Dakota, or even an IRS approved site outside the United States. So the money's protected both for the lender as well as for you. The client pays the interest on the loan post collateral. So that could be stocks, that could be cash, could be a letter of credit. We just had a situation with a client back in Mississippi where he's a developer, and so cash is king. He doesn't have a whole lot because it's always got this dollars moving. So we're using a letter of credit. And even though there's debt on some of these assets we're using, that's okay. So the money goes into a special hybrid type of life insurance contract that invests in the S&P index, invests typically in the US equity markets. And so it's building now income tax free. It's free of creditors. The bank's going to get paid back at some point in the future, 10, 15, 20 years. You can either use the values inside the insurance contract to repay the loan, or you can use other assets. One of the people on this call right now, brilliant guy, his wife normally is not that interested in some of the money sides of things, but she piped up and said, so why would we actually ever want to repay the loan if we can get this money at 2.5%, 3.5%, 4%, and we can make 7, 8, 9% on inside these insurance contracts? Why would we ever want to repay the loan? It's like, wow, what a great observation. That's exactly right. So typically the repayments come in 10, 15, 20 years. But all the client is doing is paying interest only, and they post enough collateral. So usually within 4 to 6 years, the collateral disappears and boom. So that's a pretty extraordinary idea. It's been around, been used for over 25 years, but it's just never made more sense now because we can use it to create a tax-free income stream downstream for the client and the client's family. Could be used for just simply the children or grandchildren of a client, or also for estate tax issues and estate tax reasons. We can have money that is in this trust, again, outside then of these new changes that Biden would be having, where that money is not going to be subject to estate tax because we're not gifting the money. A bank is loaning it, not giving it, but loaning it. And then we're using that to leverage for generations, literally 365 years or longer. Now, one of the things is we want to try and make sure that the income stays below $1 million in any transaction. How do we do that? We can do that using some special installment sale techniques. There's some other things where we want to make sure that you keep the numbers low, or using one of these techniques, if we aren't causing the tax to completely disappear through using that capital gains alternative trust that I just showed you, there's some other techniques where we can at least defer the recognition of that tax for 30 years. And we're using that to sell real estate. We're using that to sell stocks, bonds, and especially using it to sell business interests, including subchapter S corporations. Now, if you have a subchapter S corporation and you're trying to sell it, you know it doesn't play well in this tax sandbox at all. But using some of these techniques, we can actually sell a sub S corporation and defer the recognition of the tax for 30 years. It won't work in some of these tax exempt trust ideas I've talked about, but sometimes we're able to convert from an S corp to a C corp or to go a different direction. But there's some different techniques we can use even on S corps. There are certain retirement trusts where you can set up. I've got a client who's a developer, super clever. So he has a small amount of money in an IRA, but he has an opportunity to buy a property at $450,000 down, and his ultimate purchase will be about $1.5 million. But with improvements and other things, he's going to be able to sell this for about $4 million fairly soon. So he came to me and said, RJ, I've been reading about self-directed IRAs to buy real estate. Could I do that with mine? My fear for him, of course, right off the bat is self-dealing issues. And I won't get in the weeds on that one either. But long and short, we're going to be able to have his IRA finish the purchase of this property, get lenders that will give him the money to complete the purchase and do all the infrastructure. And then we're going to convert his IRA to a Roth IRA before the value starts getting in big. And we're going to use it very quickly. As soon as that first transaction is done, we're going to convert it to a Roth. He has to wait 5 years or to age 59 and a half, but in this case, he's almost 15 and a half, so it'll be 5 years before he can start taking money out. But when he does, it's all tax-free. So the only thing he has to report is the value as of the time of the conversion from the IRA to the Roth IRA. Very quickly, a couple more things. I mean, I wish I had $1 for every time a client said, how come my CPA didn't tell me about this? I'm not trying to pick on CPAs. We get a lot of business from them, but you can still get a $3,600 deduction for you and your wife if you have a high deductible plan, even for 2020. So it's actually something that you could, if you haven't filed your returns yet, you could still get up to a $7,200 deduction. And that just depends on what kind of healthcare plan you had. But that's another easy way the money builds. If you don't use it for reimbursement for medical care, it just goes forward. My wife has her own little credit card that she uses to pay for her expenses for her share. And so simple. Another thing, you can set up your own consulting business. Hire your spouse, hire your kids. If you have an IRA, do what I just talked about. Convert backdoor to a Roth IRA. And especially this year is when you want to do that before tax rates potentially go up next year. Last couple of ideas is using that $11.7 million federal estate tax credit each of us has now. Plus, if we use a compression strategy, in other words, where we argue for a minority interest discount or lack of marketability, we can typically increase the amount of gift or transfer by about 30%, sometimes even more. So now is the time to do it. If you have an estate that say is 30, 40, 50, 60 million, you should be moving a chunk of that out now into a tax exempt trust, say in Nevada. And we should be talking about that, how to do that, and also why, and how to make sure that that then stays out of the federal estate tax system going forward. That could be an enormous amount of wealth, especially when you look at it over 365 years. Okay, so there's also some international statuses, but we won't take time to talk about that one. So just as a recap for today, I know we've got a lot of things that I've covered, trying to make sure that everyone who's coming in today has at least a couple things that they can walk away with. So my goal was to identify some of the areas of possible tax change, the implications of those tax changes for each of us. Well, how does that matter? But also some strategies for dealing with those changes, no matter what may come. And the beauty of it is that the fact is we've got 52 years of rules now. The Tax Act of 1969 likely would never have passed if it was in this Congress over these last few years, the amount of infighting that's going on. But because that is long-standing in the tax code, one of the other things as well is if we were to use some transactions, and I don't see them making any changes to that because it would get the charities grossly upset, as well as other families. But even if they did make a change, that's where grandfathering comes in. And with some of the other strategies I've just alluded to today as well. If you do it and they make changes, which is unlikely on the 1969 Tax Act and the number of tools there, but if they did, you're grandfathered, you're covered. So just in some wrapping up thoughts, we offer something we call quote actions from a very dear friend of mine, that a very clever idea. It's not, we didn't create it, but we use the heck out of it. We send out hundreds of them every day. We also have something that's called the Key Financial Guide, and I'll show that to you in a minute. But here's an example of quote actions. And as I say, we have literally hundreds and hundreds of these going out electronically every day. You can't live a perfect day without doing something for someone who will never be able to repay you. Famous basketball coach, UCLA basketball coach, John Wooden. And there's an action, there's a challenge that follows these great quotes. So the action for today is to make an anonymous donation or do something nice for someone without them finding out that you did it. Have an extraordinary day. Completely free. You can have these once a day, once a week, twice a week. No one will follow up with you. Nobody makes a phone call. So again, it's just something we can give to you to make your day a little bit better. We hear all the time. People say it's the first email that they open up. This is the 2021. We have, I mentioned, clients in 19 states, so we can't do anything state specific, but this is all federal. And you can see that there's capital gains, there's ordinary income. And once the new changes come out, we will get this updated as well and pass them out. But we also can provide them electronically to you. So if you want that, let us know. We'll get it to you, either in paper or electronically. And all you have to do is just simply text the letters WLG on your phone. Just go to 22828. It's 22828. That's who you send it to. And then just type WLG in the body. And then you'll get a response from us. We'll get your email address, and that way we can add you to the quote actions if you want, or find out if you want the key financial data. We also, there's on our website, wealthlegacygroup.com, we have a free 12-part retirement video series that we've heard from so many that they found it enormously helpful, which is very gratifying. But we also have a lot of other videos there, buy-sell agreements, a number of other different types of things. And if you want a 15 or 20-minute complimentary conversation about your situation or maybe a client situation, we're happy to do that for no charge. Again, whether it's about your retirement, estate planning, other issues, philanthropy, happy to do that. And then the last thing, I just want to remind you, if for some reason you haven't donated yet, if you would please send a check into the food bank. I'm so delighted that we've been able to raise as many dollars as we have from our generous listeners like yourself, but please help us to be able to provide even more meals back to San Diego. The San Diego Food Bank is just doing an extraordinary job. So with that, thank you very much. Goal was to get done in less than an hour, and we're at 54 minutes, 32 seconds. So thank you for being with us again. If you have a question, anything we've talked about today, or if you want to have a call, we can discuss it, just send an email, rj@wealthlegacygroup.com. rj@wealthlegacygroup.com. And also, if you've got some ideas about some other topics that you'd like to have us do in a webinar format, or some other speakers that you would like to have us include, we do a number of different webinars. If you go to our website under our video section, you'll see that. And also you'll find something that I just did recently, 2 weeks ago, with Tom Rogerson. Tom works with some of the wealthiest families in America on the human side of things, on the family side of things. And he has some of those pertinent, thoughtful conversations about what he does with families to bring the fact we're all broken. You know, we're all whacked. Some days I'm more whacked other days, but we're all whacked. Any wonder that our families have trouble staying together. So we know that 3 generations is basically how long most families last. The wealth is gone, the families are gone, but the wealth doesn't disappear. The families don't disappear because the wealth is gone. It's the other way around. The wealth disappears because the families disappear. So you will want to listen to Tom. Brilliant, brilliant thoughts. So with that, God bless. Thank you so much for being with us. We do truly live in the greatest country in the world. Yes, we've got some issues, and a few of them are on display on the news cycle 24/7. But for all things, I'm grateful. I'm grateful to be an American. I'm grateful that you would spend your time with us today. Again, thank you, and God bless. And God bless America.